Hello, good afternoon, and welcome to the Tax Credit Co.'s webinar on the Affordable Care Act compliance, topics of 1095-C and making it simple. We hope to provide some answers and insight into the 1095-C during our time together today. My name is Lorraine Peroni, Senior Vice President with Tax Credit Co. And before we jump in too far, I want to introduce myself and tell you a little bit about my background and our team. Lorraine Peroni, Senior Vice President, been in the tax credit and ACA space for over 19 years, held leadership roles with a number of Fortune companies before joining the experts here at Tax Credit Co. Our presenter today is Max Schenker, Vice President of Client Services and Government Affairs, who's been with TCC for nearly 15 years. Over that time, he has helped Tax Credit Co. to develop industry-leading processes and systems to optimize tax incentive outcomes for our clients, and has worked closely with many of our largest clients. Over the past year, Max has been an integral part of the team responsible for introducing Tax Credit Co.'s ACA Compliance offering. I'm also very fortunate to work with a team of people here at Tax Credit Co. who are recognized as leaders in their fields with an impressive trail of publications, board memberships, and diverse backgrounds behind them, all leading to a staff of over 100 tax credit and financial professionals with Fortune 500 experience across many major industries. We have been in business for over 19 years, serving all sizes of clients with a technical expertise in certain key industries, such as retail, manufacturing, and other service-related industries. We have dedicated support teams to ensure our clients' success, and we are happy to be here to talk about ACA compliance today. Next slide, thanks Max. All of this to say is that when we tackle a client's challenges, we do it with a wealth of knowledge and experience, and our team aims to simplify the inherent complexities of tax credits, incentives, and that's what we're going to do today when we talk to you a little bit more about ACA and these forms that have presented some particular challenges to employers as we near the first year of the requirements to file and complete those. Max, I'd like to turn it over to you now.
Thanks, Lorraine. So today, instead of trying to give a comprehensive overview of the reporting requirements for the Affordable Care Act, I thought we'd talk about something more focused. There's already a lot of great material out there on ACA generally, on the employer mandate, and on the IRS reporting requirements. And at this point, I'm assuming you have a pretty good idea of the major themes and requirements of ACA compliance. So I wanted to focus in on just one specific topic that I know is particularly challenging. Today, we'll cover first a discussion of the various codes that can be used on lines 14 and 16 of the IRS Form 1095-C. Second, a new way of organizing those codes, which we think simplifies understanding their functions and how to determine the correct ones to use. And lastly, we'll go through some examples to begin to see the implications that these codes have on potential employer penalties. So what we're looking at here is the finalized IRS Form 1095-C for 2015. This form, along with the final instructions and the related Form 1094-C, were posted by the IRS just on September 16th of this year. And today we'll be focusing on lines 14 and 16. A Form 1095-C needs to be completed for each full-time employee and provided to those employees by January 31st, 2016. That's the date the forms need to be postmarked if you're mailing them. This year that's a Sunday, so you really have until February 1st to send them. Keep in mind that being late to furnish these forms to employees or late in filing them with the IRS, which is due in March, can cause penalties of up to $250 per form. Now, when we say full-time employees, we're referring to employees who are defined as full-time based on the regulations of the ACA. Basically, that means employees hired into positions that the employer knows are full-time, like a salaried position, for example, and also variable hour employees who have been measured as working on average at least 130 hours a month over the course of a measurement period. What I'm saying is that you don't need to complete a Form 1095-C for every employee who happens to work more than 130 hours in a single month, unless you're using what's called the monthly measurement period, which I think is rare. However, if an employee is full-time by ACA standards, even for 1 month of the year, then a complete 1095 form is required with all 12 months of information completed. The 1095 is being used by the IRS to accomplish a couple of different objectives. Primarily, along with the Form 1094, it's the tool that employers will use to self-report their compliance with the ACA employer mandate. In addition, the IRS will cross-reference the 1095s using the Social Security numbers of the individuals to those employees' individual tax returns in order to determine if those individuals have incorrectly claimed a health care subsidy, also known as a premium tax credit. As we'll see, the way the form is filled out can end up with an employer self-reporting that they are liable for one of the ACA's pay or play penalties. If we go back then and look at the form, we'll first take a look at line 14, which the form refers to as the place to fill in an offer of coverage. The IRS instructions to the form describe the purpose of this line as specifying, quote, the type of coverage, if any, offered to an employee, the employee's spouse, and the employee's dependents. The values that go into the fields on line 14 consist of a series of 9 code possibilities, 1A through 1I, which are referred to as Code Series 1. As you can see by the layout of the form, information has to be provided for each month of the calendar year unless all 12 months are identical, in which case there's an option to fill out a single field for all 12 months. It's important to note that unlike line 16, which we'll talk about later, line 14 cannot be left blank. One of the 9 codes must be populated for each month of the year, or to say for all 12 months. The definition of those codes can be found in the IRS instructions to the form. Let's take a look at those. Here's a list of the explanations of the codes as they appear in the IRS instructions. They're not easy to understand. I'd like to present these in a way which will hopefully simplify understanding how they're meant to be applied. So since these codes are so complex, I find it helpful to group them into categories. There are codes that, 1, indicate if a qualified offer of coverage was made, and 2, if one was not made. Then we'll talk about that third group in a bit. On line 16, the taxpayer has the opportunity to justify why an offer might not have been made. If we look at the first group of codes, these are the codes that indicate that an appropriate coverage was offered to the employee for the month. Note that in order for coverage to be considered as offered for the month, the offer had to cover the entire month. Otherwise, it's not considered to be covered for that month at all. Code 1E indicates the most coverage an employer could offer. It means that minimum essential coverage providing minimum value was offered to the employee, their spouse, and their dependent children. While the ACA requires employers to offer coverage to their full-time employees' dependents, it does not require offering coverage to the spouses. But if they do offer coverage to a spouse, the IRS wants to know about it. As we mentioned before, the IRS plans to use this form to cross-reference to individual tax returns. And if they see that someone was offered coverage by their spouse's employer, they will know that that individual is then ineligible to receive the premium tax credit subsidy. Moving on from 1E, the difference between 1E and 1C is that 1C is used when dependents were offered coverage but not the spouse. So both 1E and 1C are examples of the kinds of coverage that the employer is obligated to offer to their full-time employees. As long as there was an affordable offer, which is addressed on line 15, these offer codes mean that the employer should be safe from a penalty connected with this employee for the months in which these codes are used. Code 1G is used for self-insured plans when the employer may be covering employees whom they would otherwise not be required to cover, like a part-time employee, for example. Again, this is to help the IRS police the individual subsidy side of the law. The second set of codes all indicate that ACA compliant coverage was not offered for the month. Of course, there could be very legitimate reasons why no coverage was offered. For example, the individual might not have been hired yet at that point of the year, or the employee was still in their initial administrative period. On line 16, the employer has the opportunity to explain their justification for not offering coverage if they didn't. Codes 1B and 1D describe cases where coverage was offered either to the employee only or to the employee and their spouse, but not to their dependent children. In general, coverage that does not include dependent children is as good as not offering coverage at all, as far as the ACA goes. However, in certain limited circumstances, there may be some transition relief for 2015 where an employer may have more time to expand their coverage to include dependents. If that transition relief does apply, then codes 1B and 1D might represent qualified offers of coverage. Code 1F means that coverage was offered, but the coverage didn't provide a minimum value. Code 1F is very interesting when it comes to calculating penalties. We plan to discuss calculating penalties in more detail in a subsequent session, but as a preview, an offer of coverage, even if it doesn't provide minimum value, can still be counted as an offer when calculating compliance with the 4980HA requirement. That's the requirement to offer coverage to 70% of full-time employees in 2015 and 95% of full-time employees in 2016 and thereafter. But at the same time, the offer is not compliant with the 4980HB requirements. So while such an offer helps the employer avoid one penalty, it indicates a liability for the other penalty. Then code 1H means that no coverage was offered for that month. Again, there could be a good reason why it wasn't offered, and that will be taken care of on line 16. These last two codes are far less likely to be applicable, and the other codes can really be used to arrive at the same conclusions. These codes were introduced in an effort to help simplify reporting for certain cases, for certain employers, but the consensus seems to be that they really end up making it more complicated, so our approach is generally to ignore these two codes. So if we look again at all of the codes, we'll see that the first grouping are called qualified offers of coverage, and this means that you've provided the right amount of coverage for the employee and are likely to be free of penalties. The second group are non-qualified offers and essentially tell the IRS that you expect to pay a penalty for that month. Let's turn now to line 16. Like line 14, line 16 is also completed using a series of codes. This time it's called the Series 2 codes. For line 16, there are 10 possible entries, 2A through 2I, which is 9, plus the option to leave it blank when none of the codes apply. Unlike the offers of coverage codes on line 14, the codes on line 16 can be used to describe a few different situations. The IRS described this line as a place to indicate, quote, safe harbor codes and other relief for employers. Generally, These codes are used to explain why non-offers of coverage reported on line 14 were allowed, or that declined offers were qualified offers. So there are 9 possible codes for each month on line 14, and another 10 possible values for each month on line 16. We thought about how many possible combinations there were to figure out for each month. It's not simply 9 times 10 because some of the combinations are clearly incompatible, like you can't use 1H, meaning that no coverage was offered, and then use 2C, meaning that the employee enrolled in coverage. Altogether, for each month, there are at least 50 different code combinations possible. Here are the descriptions of the 2 series codes from the IRS instructions. I'm just not going to comment on those. Again, it's helpful to group the codes into categories. There are often cases where more than one code will apply to the same employee for the same month. So there are rules regarding which code to choose when more than one apply. For example, code 2C is used when an employee enrolled in coverage for an entire month, and that code trumps any other code that might also apply. Code 2C is in a category of its own. Once an employee enrolls in the coverage offered, they demonstrate that they are willing to take that coverage. Therefore, when code 2C is used, that means the employer is immunized from being subject to a penalty for that employee for that month, if they are as long as they're meeting the minimum compliance of covering at least 70% of full-time employees. Code 2C is also the most versatile of the codes, and it can be paired with almost any code from line 14. The next 4 codes are used to explain why, when no coverage was offered, the employer was justified in not offering coverage, and is also therefore not subject to a penalty. Code 2A is used when the employee wasn't yet an employee for that month. Code 2B is used if the employee wasn't full-time that month, and a couple of other less common situations. 2D means that the employee was in a limited non-assessment period, during which the employer is not yet obligated to offer coverage, such as during an initial measurement period or an initial administrative period. It's important to note that the exemption from penalties during a limited non-assessment period is contingent on offering an eligible employee coverage on time. So let's say an employer measures a new variable hour employee for a 12-month measurement period. If that employee turns out to be full-time and the employer fails to offer them coverage after an appropriate admin period, the employer retroactively loses the exemption for the limited non-assessment period and will be on the hook for potential penalties back to the hire date of the employee. Finishing up this group, if an employer has a non-calendar plan year, there's certain transition relief that applies to the months of 2015 before that plan begins. Code 2I can be used for those months. There are a number of conditions placed on using this transition relief as well. For example, the employer must have had a health plan continuously in place since December 27th of 2012, and the plan year cannot have been altered to a later month between then and 2015. So if someone had a plan year with an April start date in 2012 and 2013, but then changed their plan year to start in June of 2014, they will lose the benefit of this transition relief, and they'll be fully obligated in all of the employer mandate obligations starting with January of 2015, even though they have a non-calendar plan year. These 3 codes, in the third group, all describe the options for affordability safe harbors. If the employer offered coverage but the employee declined that coverage, then there's a question of whether the coverage offered was affordable. because if an individual was not offered affordable coverage by their employer, then they would be eligible to receive a government subsidy from a healthcare marketplace. Conversely, if the individual was offered affordable coverage and decided not to enroll in it, then they're ineligible for the subsidy. We said that Code 2C actually trumps all of the other codes. So even if the offer wasn't actually affordable, but the employee decided to enroll anyway, then that's on the employee side, not the employer's. It's not the employer's problem anymore at that point. Affordability is defined as not more than 9.5% of the employee's total household income. But employers really don't have any access to the employee's total household income. So the regulations provided 3 options for an employer to meet the affordability requirement based on things that the employer would know, the employee's income alone. And as long as the employer can demonstrate that they made an offer according to one of those safe harbor methods, they have fulfilled their obligation. Code 2E is used where employees are covered under a multi-employer agreement, usually a function of collective bargaining. In the latest revision of the IRS instructions, they clarified that for 2015, 2E should always be paired with 1H on line 14. And they also say that might change in subsequent years. Leaving line 16 is also an option. Leaving it blank is also an option, but it will generally indicate that the employer will be assessed a penalty for the month. As a rule of thumb, if line 16 is blank, the employer will likely be assessed a 4980HB penalty. If it's populated, the employer will likely not be subject to a penalty. Let's take a look at a couple of examples. In this first example, we see code 1H being used on line 14 for January, February, and March. Code 1H means that no offer of coverage was made. If we look below to line 16, we can see that code 2D is being used to explain why not. Code 2D means that the employee was in a limited non-assessment period during those months. In this example, the employee might have been hired in December of 2014 into a full-time position. The 3 full months following the hire date were used as an administrative period, which is one of the limited non-assessment periods, and then coverage was offered effective beginning with April. That's reflected on line 14 with code 1E starting in April, meaning that full family coverage was offered. Looking down to line 16 again, we see code 2C, which tells us the employee enrolled in the coverage that was offered. The value appearing in line 15, $84.22, represents the employee's share of the lowest cost monthly premium for self-only coverage. So that isn't the cost the employee is actually paying. It's not his portion of the premium. The value is strictly for the determination of affordability. But since the employee enrolled, then the affordability question really became moot anyway. In this example, we're looking at a case in which the employer will be shielded from any penalties related to this employee as long as they're compliant with covering enough of their full-time workers overall, which is 70% in 2015 and 95% thereafter. Let's look at another example. In this second example, we see again code 1H being used on line 14, this time for January through July. 1H again means no coverage was offered. On line 16, we see code 2D telling us that the reason why coverage was not offered was because the employee was in a limited non-assessment period. So given how many months the limited non-assessment period lasts, it looks like this is a variable hour or part-time employee who was in a measurement period and was deemed to be full-time and therefore eligible for coverage starting in August. Looking at line 14 for the month of August, we see code 1F. Code 1F means that coverage was offered, but it was coverage that did not provide minimum value. At the same time, we see that line 16 for the months of August through December are blank. This tells us a couple of things. First, it tells us that the employee did not enroll in the coverage. It also tells us that none of the affordability safe harbors are being used. However, the lack of an affordability safe harbor isn't relevant in this case because Code 1F is already telling us that there's a problem with the offer. By offering coverage which does not provide minimum value, the employer is self-reporting that they should owe a penalty for these months. The penalty will only be triggered if the employee on their own also goes out to a marketplace and receives a premium tax credit. Since the employee didn't enroll, there's a good chance that will be the case. On the other hand, if the employee had enrolled, and then we would have seen code 2C here, then the employer would no longer be liable for the penalty even though they offered something which wasn't fully compliant with the ACA. This still raises a couple of sticky issues. This text here is taken from the IRS instructions on page 14. If you look at the definition of limited non-assessment period in the IRS instructions, it says, the first 5 periods described below are limited non-assessment periods only if the employee is offered health coverage by the first day of the first month following the end of the period, and are limited non-assessment periods for Section 4980HB only if the health coverage that is offered at the end of the period provides minimum value. Of course, this statement is based on the final ACA regulations, and what it's saying is that once an employee is eligible for an offer of coverage, if the employer is late in making that offer, then the immunity or relief from penalty obligations during the measurement or administrative period is retroactively rescinded. The normal sequence would be, for example, an employer hires a new variable hour employee whom they track hours during a 12-month measurement period. If that employee turns out to work on average more than 30 hours a week or 130 hours a month, then the employer can apply an administrative period, let's say 1 month, and then offer coverage to begin on the beginning of the 14th month immediately following that admin period. However, if that offer is made late, maybe on the first day of the 15th month, then retroactively, except for the first month, the employee will have to be counted as a full-time employee who was not offered coverage for both the 4980HA and B penalties all the way back till their hire date or to the beginning of 2015 if their hire date is before 2015. So if we look back at the last example again, while the offer may have been given on time, in this case, code 1F means that the offer did not meet minimum value. And based on the regulation we just saw, that means that the prior months, which were coded 2D, meaning limited non-assessment period, are now incorrect. Because the offer was not eligible, and the same would apply if the offer would be made late, the relief provided by the limited non-assessment period is now retroactively removed, and the taxpayer will be liable for the 4980HB penalty back to January. So to review again what we've talked about today, we discussed the purpose of the 1095-C report and some of the ways the IRS will use the form. We described the various complex codes needed for the lines 14 and 16 of the 1095-C. We presented a new way of organizing those codes in order to simplify understanding their functions, and we saw some specific examples that started to tell us about how the form, the 1095-C, can be used to report and calculate the ACA employer mandate penalties. So, Lorraine, I think we had some questions that we had heard recently that we wanted to talk about as well.
Yeah, perfect. Thank you, Max, and thank you for going through that complex topic. Hopefully it provided some illumination on some things for our guests. So we compiled some questions that we hear frequently, thought it would be worthwhile to vet those out here at the webinar as well. So question 1, Max, I have 100 employees, all of which are full-time, and I offer them coverage within the 90 days of hire. So how is this complicated?
So it's not so complicated. As long as you don't hire anybody during the year and nobody terminates during the year and none of the employees have any children during the year and there aren't any dependents that are covered that turn 27 and then are no longer eligible for coverage. So because of all of these different changes and shifts that happen during the year and the requirement to report on the 1095 what's going on every single calendar month, even a simple situation like the one you're describing can become complicated.
Yeah, got it, with the normal course of an employee's life cycle to be expected. So next question we hear, so the 1095s are complicated. What steps do I need to take to make sure that my reporting is done accurately?
So the first thing you have to do is to make sure you have the data coming from the various data sources that you're going to need, which are, generally speaking, payroll and benefits. In order to establish the baseline for 2015, if you're using the look-back measurement period methodology, then you're going to have to look at over 2 years' worth of data, especially the payroll data, depending on what kind of measurement periods you're using, to figure out who is going to need a 1095-C at all in 2015. Then you'll have to look at the ACA status and of their offers of coverage for all 12 months for those employees and figure out the correct codes that go on the forms. And you want to make sure that you're understanding other kinds of rules that are going on there at the same time, measurement, transition, leaves of absence, and so forth. You're also going to want to make sure you have enough time between when your final 2015 payroll is run, which is be sometime available to you sometime in January of 2016, and when you have to get these forms into the employee's hands by February 1st. I think it's unrealistic, but the IRS has an estimate of 12 minutes per form. But if you even at that estimate, if you calculate it out, if you had 500 employees, that would be 2.5 weeks of full-time work for a single person just to fill in the forms correctly.
Assuming the 12 minutes was inaccurate. It sounds like you doubt that.
Yeah, I think that's 12 minutes once you know all the information that needs to go on there.
Mm-hmm. Makes sense. So another question was that we hear, so how will the IRS use these forms? How do we anticipate them using the forms, and what's the impact to the employer?
Yeah, so like we talked about, the forms are really for a couple of reasons, and the first thing I think the IRS is going to do with them is match up the Social Security number of the employee that's on the Form 1095-C with their individual tax filing, the Form 1040. And on the individual tax filing, there's going to be an indication of if they've taken a premium tax credit or not. And right away, the IRS will look for mismatches between these two forms. And in a 1095-C that indicates that the employee was offered coverage is a mismatch with a personal tax return that says that they took a tax credit. So that's, I think, the first thing that's going to be used for is to police the individual mandate side of the law. Then on the other side, like we said, a lot of these codes and also information that's going on the 1094, which we didn't talk about today, really indications from the employer themselves that they would owe a penalty, either for a specific month for a specific employee, or if they if they're saying that they're offering less than 70% of their full-time employees coverage, that would be what's called the large penalty, the A penalty on their entire full-time employee base. So I think the form is performing these multiple tasks for the IRS to figure out who owes penalties, both at the individual and at the employer level.
Plus whatever they may come up with in between, right?
Sure.
Yeah. Okay. And so then another question that we've seen, now that we understand that as we've tried to simplify this and believe we've gotten some simplicity wrapped in, there's still a certain number of complexities. I'm not sure I'm going to make it. We have clients say to us, I'm not sure I'm going to be able to do this on time. Can I get an extension, and what are the penalties for furnishing them late if I absolutely can't get this done?
Sure. So, as of now, where we are in November, we still think there is enough time to get these things done by the end of January. And again, you also have until the end of March to do the filing with the IRS itself. So that filing with the IRS is the 1094 filing, which must be done electronically if you have over 250 full-time employees. And that's due by March 31st of 2016. In the most recent version of the form instructions, the IRS does give you a way to get a simple extension for 1 month on that IRS filing, on the electronic filing. What they say is you have to fill out a IRS form 8809 before the due date, and that will get you an automatic 30-day extension for the IRS filing. I think what they're anticipating is that people will have some difficulty with the technical requirements, or that they're anticipating the IRS themselves will have difficulty getting the technical requirements sorted out for the electronic filings. They also talk about getting an extension on furnishing the forms to employees due on February 1st. And they describe the method of filing, of asking for such an extension, but they also say that that's not an automatic extension. And the people that we've talked to have advised us that it's probably quite unlikely that they would be granting exceptions. There might be situations like a natural disaster or something which would necessitate getting an extension that they would grant, but in the normal course of business, they would not grant extensions to filing for furnishing the forms to individuals. And there are some pretty significant penalties for filing these forms late or not at all. If the forms are late, then the penalty, the baseline of the penalty is $250 per form, which was owed. If you can get that done within the first 30 days, so they're less than 30 days late, then the penalty is only going to be $50 a form. If you can't do it within the first 30 days, but you can do it by August 1st, then the penalty is $100 per form. There are some opportunities to explain to the IRS why you're late, and that you did all the right things and you still weren't able to do it, and there will be some waivers granted on those fines, and we think that they'll be more generous this first year with some of those waivers, but at that point you're at a disadvantage starting from the place of owing a large penalty and having to ask them to forgive it. So definitely worth the effort to get these things done correctly and on time.
Yep, sounds like. All right. Well, thank you. Thank you, Max, for tackling the topic and some of the questions that we've heard. To those who have joined us, we hope you've learned something new today and have a better sense of some of the nuances of the 1095-C, specifically lines 14 and 16. If you're interested in receiving a free consultation to assess ACA readiness or compliance, or want to know more about our audit-ready compliance offerings, please reach out to us anytime. You can email us at info@taxcreditco.com, or visit our website, taxcreditco.com. Thank you again for joining us, and we hope we'll see you again at the next webinar that we host soon on another ACA topic. Thank you very much. Have a good day.
Thank you, Lorraine.
Thanks, Max.